Global debt is at dangerously high levels. I know I said this before, but it needs to be said again since it is a huge problem. This is a broad-based phenomenon, with government, private, domestic, and external debt all at record high in developed and developing countries alike. The year 2020 led to the largest single-year surge in global debt since 1970 because of the pandemic response. In my last video about global debt, I talked about a number of things, including an overview of the current debt situation, examining the waves of debt accumulation over the past 50 years, and a deep dive on how excessive debt can hurt an economy, with a simple overview on the Chinese property bubble and Sri Lanka's economic crisis. Today, I will still talk about debt but from a different angle since I felt like I left something out. And there is only one question that we will try to answer in this video. If a country experiences a debt crisis, how could the government deal with them? This is an important question because a debt crisis is becoming more likely in many parts of the world. And looking at the array of possibilities on how to handle that crisis will be very useful. So let's get started right away. Okay, so there are a number of ways on how governments can reduce their debt obligations. Some of them are pretty straightforward, but most of them will have severe political, economic, or social costs. We will talk about some obvious solutions like tax the rich and fiscal consolidation, but we will also talk about not so obvious solutions like inflation and financial repression. And by the way, keep in mind that every country will have different optimal solutions depending on the type of debt and the unique economic situation of the country. The first and most obvious solution to high debt is just grow faster. After all, if an economy grows faster than the debt, then it will be far easier to pay for the debt obligations. The US, for example, was in a dire situation after World War II, as the debt to GDP ratio hit 113%. Its debt was at $241 billion in 1946, or about $3 trillion adjusted for inflation. But there was no debt crisis. Instead, the US experienced phenomenal economic growth and consolidated its position as the wealthiest country in the world. A 2015 paper published by the Harvard Kennedy School titled Dealing with Debt explained this phenomenon. They argued that reintegration of military personnel into the workforce along with increasing innovation after the war caused faster growth that helped reduce the debt burden. And from 50 developing countries that did not restructure their debt from 1980 to 2010, as three major crises hurt the global economy, simply growing fast was the main driver of debt reduction. Of course, this strategy of just grow faster is far easier said than done, especially when we consider a lot of countries that are still struggling with COVID. Sri Lanka, for example, is experiencing one of the worst economic crises in its history, in part because it had massive debt obligations and the just grow faster strategy didn't work, as their economy is highly dependent on tourism, which was hit hard by COVID. And the country has only become more unattractive for tourists due to mass protests and social unrest within the country. Another reason why the just grow faster strategy is easier said than done is actually pretty obvious. There are not a lot of countries capable of growing fast when it has mountainous debt obligations. A lot of research has found that very high debt levels have been associated with lower growth. This is because high debt is a source of uncertainty that may reduce business investments and consumptions in the country, which leads to slower growth. The next potential solution is through fiscal consolidation. This is usually done by reducing government spending and increasing revenue through higher taxes, although consolidation plans may vary from country to country. This is by far the most likely solution for mountainous debt, and over the next few years, we can probably see lots of countries implementing fiscal consolidation to reduce their debt. But again, this isn't as easy as it sounds. For countries with great uncertainty about their growth prospects while facing higher interest rates at the same time, which is basically the situation of almost all developing countries right now, it may not be enough. While over-reliance on fiscal consolidation may actually do more harm than good. And we haven't even mentioned that both reducement in spending and tax increase are both politically unpopular. The next potential solution is privatization. When facing a debt crisis, the government will usually sell state-owned companies or land to help finance their debt obligations. This is also one of the likely solutions, and we may see this a lot over the next few years. Unfortunately, while privatization is great for overcoming serious short-term liquidity shortages, it doesn't do much for the long term unless it is accompanied by efficiency gains when private entities take over public assets. Normally, this is not a problem since privatization tends to bring higher growth and increase efficiency. After all, private entities are more incentivized to gain profits and increase efficiency than the government, right? Well, yeah, but this is not always the case. In Latin America, privatization of state-owned companies tends to increase inequality. And in 1990s Russia, mass privatization only brought all kinds of problems like creating the rise of oligarchs that severely increase inequality while not bringing much revenue to the country. So, privatization needed to be done correctly for it to work. The next potential solution that is also likely to happen is tax the rich. This is an increasingly talked about solution that may help reduce debt and inequality at the same time. Part of this increased interest is due to increasing inequality in many countries throughout the world. Similarly, many have recently suggested a one-off wealth taxes to help reduce the debt burden from the pandemic. Sounds like a great solution, right? Unfortunately, it is hard to say. A 2018 report by the OECD states that for countries that have implemented wealth taxes like Norway, Switzerland, and Luxembourg, the revenue only makes up for about 0.9% of GDP, compared to about 40% for taxes as a whole. Part of this is because wealthy people can just shift their assets offshore, and it also has the implication of discouraging investment in the country, which may do more harm than good. So, taxing the rich may help to reduce inequality and debt, but the impact may be too small to be meaningful for a country with lots of debt. Okay, so we talked about some obvious ways on how to reduce debt and handle a debt crisis. But what about the not so obvious ways, like inflation? Believe it or not, high inflation, especially hyperinflation, can help reduce debt burden, as it causes the value of a currency to decline over time. In other words, cash today is worth more than cash in the future. So inflation lets debtors pay lenders back with money worth less than it was when they originally borrowed it. A 2011 paper titled Using Inflation to Erode US Public Debt examined this phenomenon. It researched how inflation helped the US to erode its debt obligations after World War II, and it estimated that high inflation reduced the US debt by about 1/3 in a decade. Similar effects can also be seen in Latin American countries during the Latin American debt crisis in the 1980s. High inflation is such an effective way of reducing debt to the point that some researchers have recommended engineering inflation with fiscal and monetary policy to reduce high debt after the COVID pandemic. Of course, you should already know the problem with this method. Using inflation to reduce debt burden is very risky, and there are lots of things that could go wrong, like higher cost of living, reduced business investments to rising unemployment that may do more harm than good. And if a country either has large amounts of short-term debt or a large share of foreign currency debt, then this method just won't work. If a country has a large share of short-term debt, then interest rates on the newly issued debt will rise as inflation rises and short-term debt is rolled over. If a country has a large share of foreign currency denominated debt, then the currency depreciation that usually comes along with inflation will only increase the debt burden, making the problem even worse. The next not so obvious potential solution to reducing debt is called financial repression. Basically, it is a mechanism in which the government channels funds from the private sector to themselves to reduce debt, allowing them to borrow at extremely low interest rates. And along with inflation, it works like an indirect tax that forces the public to pay down government debts. They do this with subtle tools like zero interest rates and inflationary policies to essentially steal growth from the economy. Combined with high inflation, this is actually a great way to reduce debt. A 2015 working paper titled The Liquidation of Government Debt estimated that in 12 countries after World War II, financial repression liquidated government debt by 1 to 5% of GDP per year. But of course, bondholders lost a lot of money in this period. which ties in with the disadvantages of financial repression. It discouraged more productive uses of savings, lowered investments, and reduced financing access for small borrowers, which caused low growth in Latin American countries in the 1960s. Furthermore, once implemented, financial repression is difficult to unwind. In 1970s Latin America, interest rates continued to be low several years after financial repression ended, fueling another debt build-up which caused yet another debt crisis. Okay, we talk about many ways and mechanisms to reduce debt, but what about defaults or restructuring? After all, these are what we heard the most in the news. For foreign debt that's owed to foreigners and denominated in foreign currency, debt restructuring is probably the only option, as methods like inflation just wouldn't work. And foreign creditors cannot be coerced the same way as government can coerce domestic bondholders. This is why over the past 200 years, developed countries defaulted more than twice, and developing countries defaulted more than 4 times on foreign debt compared to domestic debt. While debt restructuring and defaults can be a good solution, it imposes long-term economic costs, especially for countries with long histories of debt defaults. Some examples include Venezuela, Greece, and Mexico. And also, if the restructured debt is held by domestic banks, then it has the implications of weakening the bank's balance sheet and undermining financial stability. This had actually happened before in Greece when in 2011, domestic banks sustained losses during sovereign debt restructuring. So far, we have reviewed some solutions to help reduce debt in an economy. However, all of these solutions have their own drawbacks and have the potential to do more harm than good, which may lead to numerous human suffering. So, there really isn't any attractive or easy option. Debt in developed and developing countries has risen rapidly since 2010, and there are many ways on how this rise in debt can hurt our economy. If you want to learn about it, make sure to watch my video on global debt. This is Doverhill, and see you next time.